Hello and welcome to the 2021 market update for Maher Digby. The old adage of there's no such thing as a free lunch holds true again this year, unfortunately. However, with the restrictions on venues, particularly for groups, and problems with interstate travel continuing, it's necessary to do it in this format again. 12 months ago, when we first had our online market update, Tanya and Diana were both working from home, supermarket shelves were empty, and there was a lot of uncertainty going on in the marketplace. 12 months on, who would have thought that the share markets are up at record high levels? The property market is booming. We're even selling used cars for more than what we paid for them. In terms of our client portfolios, we've seen Australian share funds perform fantastically, some over 50%. We've seen international funds preserve capital really well throughout this time, and they too are higher than what they were 12 months ago. And during this time, we've been able to use the cash within your portfolios to fund your income streams. 12 months ago, we also had the option of reducing allocated pension payments if you were drawing money from your superannuation. That meant that we could cut by up to 50% the amount of drawings from those portfolios, and many of our clients decided to do this. Come the 1st of July, the rules are going to change again, and your income, if you did cut it, will go back to what it was prior to the pandemic. This will automatically happen, and for anybody who did reduce their drawings and is wondering what their income is likely to be for the next financial year, please give us a call and we can do up some sort of estimate in terms of what your income will be going forward. We've also had a federal budget lately as well. That seems to be good for growth and really stimulating the economy. The one thing that we are looking at is the removal of the work test for people to put money into super, and making it possibly a bit easier for people to place sums of money into super up to age 75 rather than age 65 as the rules were. That's one thing that we'll be watching, and no doubt there'll be more news of that to come over time. Now on to our speakers. We've chosen two funds this year that we commonly use in our clients' portfolios, and we've chosen them because we don't know what's going on in the next 12 months, but we do know that these two funds will not get caught up in any hype or potential bubbles that are within the market. Firstly, we have Investors Mutual, talking about their Australian share fund, and then the Magellan Infrastructure Fund. Hugh Giddy from Investors Mutual will present first and give us an update on the Australian share fund. He'll talk about the sort of stocks that they invest into and why he believes that the fund is well positioned to take advantage of the current market conditions. Secondly, we have Gerald Stack from Magellan. He'll talk about the Magellan Infrastructure Fund and how that's been affected by the pandemic. We'll learn that there's a lot more to an infrastructure fund than just airports and toll roads, and he'll update us on the type of things that they're looking to invest into in order to generate great returns for our clients. First up, Investors Mutual.
Welcome everybody, and thank you for your time and attention. Thank you very much for your support, Maher Digby, and for giving Investors Mutual and myself, Hugh Giddy, Portfolio Manager at Investors Mutual, the opportunity to talk about what's been going on and how we're positioned with your clients. Investors Mutual has been in existence for over 20 years with the main Australian share fund starting in 1998, and over that time Investors Mutual has pursued a quality and value philosophy. We think it's not that sensible to just focus on price. We think it's very important to focus on quality companies that have recurring sustainable cash flows and earnings, that have a strong franchise, good management and so forth. Because that ensures that over time the company has a very reliable, sustainable set of earnings that generally lead to compound growth in share value over time, although obviously not in a straight line. We've been in a crazy phase of markets where after a huge hiccup in March last year with the lockdowns that were associated with the initial fears of COVID and the declaration of a global pandemic, governments responded with a lot of stimulus, JobKeeper, JobSeeker, and their equivalents around the world, and zero interest rates. And the result has been that a lot of people have been spending a lot of money. You've seen things like flat screen TVs flying off the shelves, and people buying a lot of takeaway food and so forth. Certain sectors have benefited a lot because of this extra money and because of changing patterns. But whether that's sustainable or not is not clear. But you have seen also some extra speculation in the market. Some people have been investing who have never invested before. A lot of small investors have been chasing things like Bitcoin, potentially losing lots of money in the process. But this is the result of this strong stimulus and very low interest rates that have distorted things somewhat, and arguably it could be time to take away some of that, but the government seems rather committed. During this time, low interest rates have pushed up the valuations of growth stocks, which we've generally avoided because we are very aware of the obsolescence you get with technology. For example, who can remember the biggest mobile phone maker? It wasn't Apple and their iPhone or Samsung, it was Nokia. Who's got a Nokia phone now? Not many people. What was the best search engine? It was Yahoo, and before that Alta Vista, and now it's Google. So you get a lot of obsolescence, so it's very dangerous to expect that companies can just grow and grow and grow in technology, because often they are out-innovated, and not all companies are successful the way Amazon and Google have been. For example, those are just two real success stories where lots of other pretenders have fallen by the wayside. So we've avoided the growth companies, and we focus at IML very much more on defensive, solid, reliable companies sometimes that have been affected by COVID, because of course you did have lockdowns and you have had scares that have kept people out of the cinema, or they haven't been able to go to the cinema, or that sort of thing. And but we try and look beyond COVID. We look for reliable companies. So there's a host of companies we own that we think are really strong franchises and are reasonably valued, and that is the core of our portfolio. Companies like CSL, they have been affected in the short term by lower plasma collections in the US because people have had stimulus checks that meant they thought, why go out and get a paid plasma donation? Tabcorp, that was initially affected because of the closure of the betting shops, but those are open again for the most part in Australia, and people are realising the value in the lotteries business. Brambles, Insurance Australia Group, AusNet, Metcash has benefited a lot as people are shopping more local, going to their local IGA and finding out what a good store that actually is compared to their memory of a sort of expensive, grubby old store that some of the Metcash IGA stores used to be like. But looking forward, where do we see things going? I think it's going to be a great time to be in quality defensive companies, because a lot of them have been left behind. They haven't really gone up so much over the last 3 years, while a lot of froth has been in the markets. The market's up more than 35% since the COVID lows, and yet some of these stocks haven't gone anywhere. They're good companies. And we're very confident that they are going to do well going forward. What will happen to the market overall? Well, that's obviously anyone's guess. But we do believe that when you've got valuations as high as they are overall, and you've got a lot of optimism around, a lot of very positive sentiment, a lot of retail investor participation, and you can look at the froth in things like Bitcoin, that it's a time to be cautious, and that returns overall will be quite subdued. So if you have a company that's paying a good dividend and looks very well valued, very well priced relative to the strength of the franchise, we think that's a good place to be. That's where we've got our portfolio, and we hope to deliver better returns for our clients in the future.
Hi, my name is Gerald Stack and I'm a portfolio manager for the Magellan Infrastructure Fund. We're very grateful for the opportunity to talk to Marr Digby and their clients today. Marr Digby have been a long-term supporter of Magellan and we're grateful for the opportunity to speak. I'm going to talk through two things today. First, I'm going to talk through the impacts of COVID and the pandemic upon the infrastructure sector. And secondly, I'm going to talk a little bit about the outlook for infrastructure as we sit here today. So let's deal with the impacts of COVID first. Infrastructure, when we talk about infrastructure, there's really two sectors we're talking about. That is utilities, regulated utilities, and transport infrastructure. Regulated utilities are involved in the provision of really energy and water. That is an essential service. It's done through a natural monopoly, and as a result, it's regulated. Governments are not going to trust companies to provide essential services with absolute monopoly power. And that regulation in a time like COVID is very much your friend. In COVID, these companies were affected. People were staying at home. There were lower volumes of energy and of water. But the companies were able to work with the regulators and able to cut costs. And as a result, something like 95% of regulated utilities on our analysis either met or exceeded their earnings forecasts for the year. So at the start of the year, pre-COVID, they had earnings forecasts that they put out. And the overwhelming bulk of these companies either met or exceeded their earnings guidance for the year. So notwithstanding it was a tumultuous year, even for utilities, they met their criteria. Transport infrastructure was a bit different. Transport infrastructure are companies that are involved in the transport of people, goods and data. And we saw quite different sets of circumstances depending on the companies. Airports faced in April last year a 94% reduction in the number of passengers flying around the world. By the end of the year, that had improved somewhat, but it was still down 70%. So a pretty stark year. Toll road traffic early on was down as much as 80%, and it recovered until such time as we had second waves, both in the Northern Hemisphere and in the Southern Hemisphere. But we did see the early signs of green shoots for toll roads, and we're optimistic about the outlook. Communications infrastructure, a third part. Communications infrastructure, if ever there was a year where the importance of high-quality broadband came home to people, it was last year. And communications infrastructure is ultimately about the movement of data across communications networks. So significant movement of volumes of data last year, continuation of a trend, and as a result, communications infrastructure did well. So if I stand back from that, utilities, very much in line with what we would have expected at the start of the year. In infrastructure, a range of outcomes. Airports, not so good. Toll roads are actually okay, albeit down on the year, but the signs of improvement. And communications actually very strong. So then how do we think about the future? Well, infrastructure as an asset class or as an investment should achieve, we believe, inflation plus 5% over time. And we see no reason to believe that infrastructure won't do that as we look forward from today. As I've touched on with utilities can provide an essential service. They're natural monopolies. They benefit from regulation, and we'd expect them to deliver reliable, predictable returns over the next 1, 3 or 5 years. Now, transport infrastructure is a little bit more complex. Clearly, airports are still at very reduced passenger levels, and we would expect it'll be sometime like 2024, 2025 before we get back to 2019 passenger levels. So a much delayed recovery and certainly a high degree of uncertainty around the outlook for airports in the immediate term. Toll roads, well, toll road traffic is ultimately a function of the number of people who live in the catchment area and the number of businesses that operate in that catchment area. And while those things may slow a little bit, we would think that you're not going to see dramatic change in those variables. As a result, traffic should come back pretty quickly. We would think over the next couple of years, you'll see traffic back to something like 2019 levels. And then finally, communications. Well, communications as infrastructure, as I've mentioned before, is about the levels of data going through communication networks over time. We continue to believe and expect that the levels of data going through communication networks is just going to grow very, very strongly. Indeed, one of the companies in our portfolio, American Tower, in their investor relation materials have suggested that it's be fair to expect something like a 30% annual growth in the level of data going through communication networks. So that augurs well for the opportunity set for those companies. So again, as we sit here today, as we look across our spectrum, inflation plus 5 is what we would expect to be fair. We see no reason not to get that from utilities. In the infrastructure world, where we have different types of opportunities, airports still somewhat risky, and as a result, it's a small part of our portfolio. Toll roads, we see real opportunity to rebound back to something like 2019 levels, and communications infrastructure really optimistic about the outlook. So hopefully that's been helpful to people. As I said, we're very grateful for the opportunity to talk to Mar Digby and their clients. Best of luck for the future.
So there we have it, the 2021 market update from Mar Digby. I'd really like to thank both Investors Mutual and Magellan for providing us with those updates and for giving us access to speakers who we would ordinarily not be able to present to our clients. As always, if you guys have got any questions or if there's anything that we can help you with, please call the office. Thank you.